Right, morning everyone. Welcome back to Morning Cuppa at AM. Joseph here. So looking at the last week price actions, can see that over the one whole week, right, Hang Seng Index have underwent a very strong bullish price actions. Can see that the Hang Seng Index managed to climb above the 20 days moving average, and it has been moving on a higher high and higher low over the week, right? And let's see what are the stocks that have left the Hang Seng Index higher. You can see that the Tencent have went up by 7%, Alibaba 17%, and Xiaomi 12%. So last week, since the share price have actually went down, correction so deep, right? Over just a week time, right? You can see that the tech stocks have rebound strongly, right? And can see that the momentum should follow through this week. Now, if that happened, right, this week, Hang Seng is going to test a very important resistance at 24,500 point level. Now, this juncture, we still keep a bearish bias on the Hang Seng Index, but we set our stop loss point at 24,500 point level. Now, apart from the tech stocks, we do see that also the look at the Li Ka-shing's related counters like stock code number 1113, right? Chong Kong Assets, also the shares have rebounded strongly. And this week, I will look at the PCCW, which is a low beta counter that owned by the Richard Lee, the one of the second son of Li Ka-shing. You can see that the PCCW that involved in the telecommunications in Hong Kong, the share price have went up by a break past the 5 Hong Kong dollar 50 cents, heading toward 570 and followed by 590. Right, on downside, support is at 530. Right, then now we move our focus on the A shares. I can see that the China A50 continue moving sideways last week, right? But over the week, can see that most of the stocks in the Chinese market underwent different degree of corrections, and only a handful of them managed to close in the positive territory. Now, one counter that caught my attention is that going for a rebound, which is the 30058, right? And these counters managed to print a very long bullish candlestick and break past the renminbi 13 and heading towards 14 and followed by 15. Downside support is at 12 renminbi, right? So as long as stay above this 13 renminbi, I think that this week this 30058 possibility to test 14 and followed by 15 renminbi. Now let's take a look at what are the news flow that affect the market sentiment over the week. Definitely is the US and Iran conflict that on Friday, right? The Iran have shoot some of the commercial ships, and the US have retaliated, and it have I think at least launched 3 rounds of attack on the Iran those military targets. And I can see that the oil price have moved up by 3% this morning. However, you look at the oil price still stay somewhere at $75 per barrel, right? And now we see that both have giving a different message that Iran have declared the Hormuz Strait have closed, but the US military mentions that the traffic is flowing. But I'm not sure if any ships were there to go through the Hormuz Straits since the Iran have started to open fire on the commercial ships, right? And Trump have mentioned last Friday that US have agreed to meet the Iran, right? But the ceasefire deal is over, so the conflict is still ongoing, and I'm not sure when that will be stopped, and ships may contemplating not to pass the Hormuz Straits at this juncture. But look at this morning, the even 3% hike in the oil price, right? The oil have not yet to move above the 200 days moving average. Now, generally, you can see that the oil has been moving on a lower low and lower high, and very strong resistance still at 78. This is where the peace deal agreement was struck in the mid of June, right? So you can see that as long as that was also a very clear gap down here from $85 per barrel, right? So from a technical perspective, as long as the oil failed to move above 78, I think market is still pricing that this exchange of fire may be temporarily, right? Once the both countries sit down to talk again, right? Oil likelihood to move back towards to 68 and followed by 60 level. So we still keep a bearish bias on the oil price, despite that there are some um hot contact recently. And then on, you can see that the gold price also moving downwards. There is a little bit of rebound recently, but it has yet also to cross above the 20 days moving average, and a very strong resistance remain intact at $4,004. So we still keep a bearish bias on both oil and gold, right? Gold, our stop loss point will be at 4,004. Now, meanwhile, S&P 500, you can see that despite that Thursday and Friday, right, Iran, US continue their war, but you can see that XPX have crossed above 7,005, right? So last week we do see some of the memory counters have corrections, but over the week, I can see that the Baton have passed to NVIDIA, right? So NVIDIA together with Meta both have lead the US higher, right? And can see that over the Friday, right, one of the Korean memory counters, SK Hynix, have made their debut on the US market, and sentiments are very strong, and money smart money moving back to the tech stocks, AI related counters on the Friday. As such, you can see that the XPX remains a bullish setup right now, right? And over the 1 to 2 weeks time, we do see that there was only a 1 day that the index falls below the 50 days moving average, but most of the time it's trading above the 50, and also right now it climbed above the 20 days moving average. So in our technical setup, we just look at a 20, 50, and 200 days moving average, and overall, I can see that the bull still in control for the XPX. And right now, after breaking past 7,005, it's going to 7,750, and in the best case, it may move to the new high at 8,000 point level. So now, apart from the SK Hynix, right, I think the smart money is going to the NVIDIA. You can see that NVIDIA have made a very strong rebound last 3 sessions, and yeah, break past 210 US dollar right now. Now, the other counters that have caught my attention is that the Meta. Can see that the Meta have been undergoing corrections, and right now the share price is much higher than where they have actually announced their result during the April. So coming to July, right, I think the Meta is going to announce the result at the end of July again. But at this juncture, you can see that the price and volume profile, a very strong support has formed at 630, right? And last Friday, it was a gap up, right? As we can also know that recently, Meta is actually announced that they have a little bit of excess capacities on the AI server they have built, and they are going to commercialize it. And initially, market give them a negative rating, but right now we can see that the based on the price actions, Mr. Market have cast a very positive vote on the Meta platform. So technical wise, I see that Meta is bullish right now, and momentum should follow through. Now, meanwhile, over the last week, Malaysia we have concluded these Johor state elections, and last 2 sessions on the especially the over the week, you can see the FPM KLCI based on the weekly chart, it managed to climb above 1685 again, right? Eyeing to test 1,007. So if this week index can move above 1,007 and close above the 20-week moving average line, then on the overall market sentiment is going to improve tremendously. So last week, the tech, utilities, and the energy, 3 sectors have lifted the market sentiment. Now, meanwhile, smart money is rotating out from REITs, transportations, and constructions. Okay. FKRI will still keep a bullish bias, and we set our stop loss point at 1650, right? And looking at the price actions, I do think that today and this week, right, FKRI or FPM KLCI do have a room on the upside. Likelihood is going to break the 1,007 and going towards 1,730. Now, meanwhile, FCPO have a very strong negative price actions on last Friday, right after the MPOB released their stats. I think afterwards, Leng is going to talk about that. But based on the price action, it shows that the market is really indecisive right now, and we keep a bearish bias for the next 2 to 4 weeks, and we set our stop loss at 4,007 at this juncture, right? And as for the trading stock this morning, we'll be looking at IHH Healthcare. The break past are 8 ringgit 40 cents, heading towards 8 ringgit 75 and going for 9 ringgit and 5 cents. Downside support is 8 ringgit and 10 cents. Now, apart from IHH, we have another big cap stocks, Press Metal, right? Since the US Iran war is coming back again, right? Let's see if Press Metal can stage a meaningful rebound, testing the 7 ringgit and 70 cents. If the breakout happens, it climbs towards 810 and followed by 850. Downside support is 7 ringgit and 30 cents. So we have both blue chip stocks, firstly IHH Healthcare and followed by Press Metal. Now we'll pass on to Sian on the weekly economics update. Thank you.
Hi, good morning. We will talk today first about Plantation stats, and then I'll pass it on to Sian later. So maybe just let me start, talking a little bit about the latest sort of weather update. So if you look at the on July 9th, the US National Oceanic Atmospheric Association released their latest forecast, and they said that El Nino has strengthened over the past month and is expected to intensify through 2026. And they've also said that there is a strong coupling of atmospheric and oceanic circulation across the Pacific Ocean, which contributes to their high confidence that El Nino will continue through to early 2027, with a 97% chance of a strong or very strong El Nino during the October to December period. So if this does come through, they said that it would rank among the largest El Nino events in the historical records, going back all the way to 1950. The Australian Bureau of Meteorology, does concur in terms of the forecast that it could be that the forecasts are pointing to a strong to very strong El Nino event. But they're saying that only half of the models indicate that this event could peak at the highest levels since 1950. So a little bit similar direction, but in terms of forecast, but in terms of the strength, they're still not quite exactly on the same page yet. In addition, the Australian Bureau of Meteorology notes that the Indian Ocean dipole is still at neutral territory at minus 0.16 degrees Celsius, and it needs to be in positive territory before a strong El Nino is confirmed. So basically, we will still continue to wait for the confirmation of the El Nino strength before we make any substantive changes to our CPO price assumptions. So moving on to the stats, if you look at June's numbers, we actually saw a pretty strong growth in terms of output still, so no weather impact as yet, where June's output grew by 8.1%, again, heading towards a seasonal peak period as well. So year-to-date growth right now is at plus 0.6% year on year. Indonesia's numbers are only up to April, but still, pretty strong production there as well, growing by about 13% year on year as at year to date April. Exports from Malaysia improved 6.2% month on month. Despite the fact that palm oil's discount actually narrowed against soybean oil, now at about $419 per ton versus May, where it was $509 per ton. But this is probably likely due to the picking back up of or restocking activities, particularly in countries where they are sitting now below stock historical levels, and that would include India and Bangladesh, where their stock levels are now at minus 10% below historical and minus 23% below historical levels in the month of May. China and Pakistan, however, are still sitting at pretty comfortable stock levels at 42% above and 17% above respectively. So with the higher output and imports, partially offset by the stronger exports, we saw June's stock levels for the month of for inventory dropped to 2.54 million tons, which is up about 4.8% month on month. Increase to 2.54 million tons, up to 4.8% month on month, and that resulted in a strong stronger annualized stock usage ratio of 12.4% versus the historical of 10%. So going forward, we expect output will continue to improve. Demand should also improve, as restocking activities continue. But at the same time, you will have Indonesia's B50 mandate beginning in July, and that would support export offtake. So we're maintaining our overweight sector rating on the sector, on the plantation sector. As mentioned, our price assumption is still unchanged at this point, which is 4,004 for this year and 4,003 for next year. But we continue to highlight that the upside risk is more on our 2027 price assumption, given the significant 12-month lag effect of El Nino. Year to date, CPO prices are at 4,356 ringgit per ton. So we're keeping to our overweight. As mentioned, our top picks are Johor Plant, SOP, ICOP, Hap Sing, and Indonesia, we like TAPG and London Sumatra. We also like S33 Malaysia and First Resources in Singapore. So let me stop here and pass you on to Sian. Thank you very much.
Thanks, Leng. So good morning, everyone. So let me share my screen. I hope we can see my screen now. So on last week, so we have published our Pathfinder, so which feature our 2026 second half outlook. So for the second half, so we do see that there are a few key things that we pay attention to. So which is the geopolitical fragility, AI rally fatigue, or not as well. So we remain cautiously optimistic in the second half. So we do see that, and we hope that for now, US-Iran ceasefire will be extended into year-end. And then over the weekend, so we see that there is an escalation of US and Iran tension. And then following President Donald Trump announcement that the ceasefire will be ended. And we hope that there will be a resolution then into the year-end. And AI-related rally will persist and continuing in a continued global risk-taking appetite as well. So while global growth and investor confidence could remain constructively supported, so we note that the recent sell-down in AI-related stocks, a worrying phenomenon that might reveal our optimistic view, should it persist into second half in this year. So and then on second half, so we see that 5 key global uncertainties might remain key points to watch. So which are the major risks and unknowns that might shape the global economic outlook as well. So firstly is the US-Iran and also Middle East tension. So we do see that the ongoing conflict, there is a risk of further escalation as well. So where potential if there is a further escalation in the geopolitical tension, there might be a potential disruptions to oil supply and shipping lanes as well. So over the weekend, so President Donald Trump that mentioned that the Straits of Hormuz will remain open to the commercial shipments. However, this is also contradicting with the Iran statement that the Straits of Hormuz will be closed. As a result, the oil prices there is an uptick in the oil prices to around $78 per barrel this morning. And then also a heightened market volatility and also risk of sentiment. And also if there is a further escalation in the geopolitical tension, there might be a broader spillover to regional stability and also global growth as well. Secondly, E&E and also artificial intelligence cycle. And third, lack of clarity over how US FFR might trend. So this is some of the key risks, and also development in the US tariff policies. And lastly is the pandemic risk. As of now, we are seeing that the current release risk level is low as well. So in the baseline, over the weekend, we are also seeing that over the last week, we are also seeing that RHB sentiment index actually continues to stay in the risk neutral zone. So pointing south as investors actually remain cautious on AI rally as well. So moving on, so in the Pathfinder itself, we have also penciled in 3 possible scenarios, where our base case scenarios is there is a perpetual ceasefire if the oil averages at around $85 per barrel. So in this case, we were able to sustain most of our key projections, including US GDP at around 2%, China GDP growth range at around 4 to 4.5, and for Malaysia, we are seeing that there's a good chance towards potential upsides towards 5% in this year. So given that the export is stronger than expected, there's also a continued resilience in the in Malaysia domestic economy performance as well, where US dollar index is likely to end the year at around 100, and also Malaysia ringgit ringgit dollar to actually end the year at around 4 per dollar. So in this case, we are seeing that the FFR is likely to stay unchanged for the rest of the year, where for next year we are penciling in there is a 2 rate reduction on the US end, with Malaysia OPR to actually maintain at around 2.75%. Under our base case scenario, we will assign a 60% probability. However, given that there is still uncertainty lingering in the geopolitical tension between US and Iran, especially following the recent escalation between these two countries. So we do see that in the worst case scenario, conflicts might further re-escalate in the third quarter. So with the oil price actually surge above 140 per barrel. So if the oil price, there is a disruptions in the oil supply, and also there is an oil price surge to around 140. So we do see that there is a significant upsides to the inflation. And for US, GDP growth is likely to slow to around 1% in this year, and China at around 4%, and Malaysia to around 4%. So in the worst case scenario, where we assign a 30% probability, and the dollar index to actually move towards 115 on safe haven and rate hike bets, when Malaysia ringgit to actually move towards 4.5 per dollar as well. So in this case, on the policy rates, so we do see that the US is likely to hike the FFR1 in this year, with the balance of risk towards 2 rate hikes due to the upsides on the inflation itself, where we also assign a 30% probability on that. So I think at least for now, although we are seeing that there are still uncertainties on the geopolitical arena, however, I think there's another supporting factor for the global and also for Malaysia exports as well, which is the AI rally. So as what we see from the study itself, so without the AI rally, global equities and growth should have been down due to the US, Iran, and also Israel tension. So without AI rally, we could likely see that there's a softer economic prognosis, so associated with higher oil price, where we are seeing in the past incidents, which including the pre-Lehman crash, and also Russia-Ukraine war, where increase in oil prices will lead to decline in the global real industrial production as well. So, and then on our modified Taylor rule to suggest that FFR will likely to stay unchanged in this year, to see that there's a 2 rate cuts by 2027 as well. So moving on into Malaysia. So for Malaysia, we maintain our GDP growth forecast at around, we maintain the GDP growth forecast at around 4.7 in this year, with a modest upside bias, supported by stronger than expected export performance and also continued resilience in domestic demand as well. So meanwhile, our leading index model do suggest that second and third quarter GDP to stay resilient at a growth range at around 4.7 up to 5.3%, following a robust growth at around 4.4% in the first quarter in this year. So for the full year, we expect the GDP to average around 4.7%, with a modest upside towards 5%. So given that exports on year-to-date basis is more robust than expected, and also there's still a continued resilience in the domestic economy, so where we get support from private consumption and also investment spending so far. So coupled with a strong E&E demand, which will also keep Malaysia economic supported for the rest of the year. So across the sectors, we do expect to see that there's a broad-based and also diversified growth drivers at the sectorial levels, so including wholesale and retail, manufacturing, and also construction, and also tourism is likely to benefit from Visit Malaysia year 2026, although the current geopolitical risk might temper some of the potential upsides for the tourism. So, and for now, on investor appetite for Malaysian equities remain cautious. So despite easing selling pressure, where bond flows improve on stable yields and expectation of an unchanged OPR for Malaysia. And for inflation, so we do expect that the inflation to actually stay at around 2.1% in this year. So, and we continue to monitor the potential upsides from changes in the commodity prices, and also change in the domestic policies, and also potential upsides from the El Nino conditions as well, as already happened now. So meanwhile, aside than our view on the Pathfinder, so last week we have also seen that there's a release of Malaysia IPI data as well as what we see from the manufacturing end. So May IPI expanded by 8.4%, which is close to our forecast of 8.7%, but falling short of the global consensus estimate of 9.4%. So we maintain our IPI growth forecast at around 4.9%, while robust year-to-date growth of 5.7% also suggests that there's a potential upsides to our current projection as well. So our manufacturing sector is expected to remain supported by sustained global demand for E&E products, resilient domestic consumption, and also supportive policy measures. So we are seeing that the continued strength in exports together with rebound in manufacturing PMI points to improving industrial momentum moving on as well. However, despite our broadly optimistic view on Malaysia manufacturing sector, so we remain vigilant to mounting upstream cost pressure, especially PPI accelerated by 7.8% in the May itself, where we are seeing that there's also broad-based increase across the sectors, so which suggests that there's a mounting upstream cost pressure, which could potentially there's a pass-through to consumer prices and have some impact on the consumer prices and as well. So over the last week, we have also seen that there's a release of the MPC results for July as well, where the OPR, as what we expected and market expected, is being kept unchanged at 2.75%. So moving on, so we do expect that the OPR to remain unchanged at 2.75%, as robust growth prospect and manageable inflation so far support a stable policy outlook as well. So in the policy statement itself, the central bank adopted a more optimistic tone of the global growth, so citing that resilient global growth driven by continued technology upcycle, improving supply condition, and moderating commodity prices as well. So we compare to the peak at around more than $100 per barrel earlier on. So despite lingering external uncertainties, IPC remain constructive on the domestic outlook, so underpinned by Malaysia's strong economic fundamentals and resilience to external shocks. So that's all from me today. Thanks for staying with us for the morning cuppa. Thank you.